Hello and a very warm welcome to Econoday Unplugged. It's Monday, 8th of January 2024. And on our first podcast of the year, we have Terry Sheehan on the US East Coast, Max Sato in British Columbia, Bron Jackson's in Sydney, and I'm Jeremy Hawkins in London. So much like 2022, there can't be many forecasters not happy to see the back of 2023. But what about this year? Will it be a hard or soft landing? Will inflation keep falling? How much of the impact of the aggressive central bank tightening we've seen since early 2022 has still to feed through? And how much of a role will politics play in what will be a big year for elections? Well, at the risk of adding more egg on the face of a soothsaying community, in today's podcast, we'll have a go at identifying at least some of the key data, events, and issues likely to be driving global financial markets over the coming 12 months. 2023 ended with a sharp rally in bonds and stocks, but this year has already started on a much more cautious note. Crucial to investor sentiment, of course, is the strong and widely held conviction that the Fed, alongside many other central banks, albeit not all of them, will soon be cutting interest rates, and moreover, will continue to do so over much of a year. Which takes us then to Terry. So, Terry, just how much pressure is there on the Fed to cut rates? And if it's going to do so as rapidly as financial markets have been assuming, what will it be watching most closely and what needs to happen?
Well, that's a long list. I think that markets are going to continue to show a lot of pressure to the Fed to cut rates sooner. I think the Fed policymakers are going to push back strongly. I think that their underlying message of fighting inflation through restrictive monetary policy is not going to change, at least based on the current data. I think the earliest we can expect to see any kind of cuts in rates would be mid-year. I think when they come, they're going to be very cautiously implemented in 25 basis point increments. And I think that their current forecast for 3 rate cuts this year is probably about right.
What needs to happen to ensure we get 3 rate cuts this year?
Well, I think we have to see the inflation data come down along the lines that the Fed policymakers are currently expecting. Right now, they're getting labor market data that's very much in line with what they've anticipated. We have a slowing, very modest, but a slowing in hiring. Relatively few people are losing their jobs. The unemployment rate remains near historic lows. And those who are working are seeing modest wage hikes. So overall, the labor market is not going to be something that the Fed needs to focus on as much as what's going on with prices.
Okay.
They will be looking at that non-housing services sector, which has been rather stubborn to respond to past rate hikes.
Right. So as lagging areas, we say the parts of the economy which have been lagging in their responses to Fed policy. Fair enough. OK, let me also ask you, with regard to Fed policy, I mean, there are some folks who maintain that in the year of the presidential elections, the central bank is that much less keen to change interest rates in either direction. Do you think ahead of November elections, that's going to have any implications for what the Fed does with interest rates?
Actually, that's something I've gone over, the Fed actions versus the timing of presidential elections back for several decades. And the fact of the matter is the Fed will raise or lower rates if it looks like the economy needs that action, and they do it pretty much without regard for presidential elections. The only real accommodation they make is they make sure that they don't have an FOMC meeting announcement or an FOMC meeting in direct conjunction with Election Day.
OK, fair enough. That's good to know in the sake of independence. Without going to want to get too much into the politics of it, Do you think it matters for financial markets which side actually wins the election, in the sense that, as I recall, if we go back to, where it was 2016, wasn't it, when Donald Trump took over in the White House? At the time, the view was that a Democrat win would probably lead to a looser fiscal policy, which would mean that much faster growth out the states, bigger chance of Fed raising interest rates, etc., etc. All good news for the likes of a dollar and so on. But of course, when Donald Trump won, then almost immediately we still had a rally in the stock market on the grounds that fiscal policy was still going to be loosened. So do you think it matters, particularly who wins the election, in terms of the implications of what fiscal policy might mean for US economic growth over the next few years?
Well, when Donald Trump won in 2016, he was largely an unknown factor. We did not know what he would be like as president. We now have a much better idea. And I think we can expect that if Donald Trump wins, there will be huge emphasis on tax cuts again. But if we have a Democratic majority in the House and or Senate, there's going to be a lot of pushback on that. I think we can look forward to narrow majorities and a highly contentious situation, which we've had for the last several years.
So it could be quite an interesting run-up in terms of the actual elections themselves. I guess almost lastly from my side, just in terms of, well, say fiscal policy, where do we stand now in terms of the debt ceiling and possible government shutdowns?
Well, it sounds like they have an agreement in place to avoid a shutdown, which would be a good thing. Whether they can get it through in time to avoid a brief shutdown or not remains to be seen. But it sounds like if they do, it's going to be handled pretty quickly.
Okay, that's got to be good news. And having said that was almost my last question, I'll ask you another one. Main risk, can I ask you, which do you think is more of a risk? Is it the case that we could have delayed reaction to earlier tightening from the Fed, which leads to a more rapid slowdown in economic activity, or return to above target inflation? Well, I know we haven't quite got there yet, but target moving further above inflation, I should say, due to the Fed cutting rates prematurely.
I think the risk would be more that the Fed cut prematurely. I think we see a lot of the impact of past rate hikes in the economic data right now. And I think the pause in the FOMC's rate cycle, which looks like it's going to be at its peak, is an indication that they are being very cautious about adding more restrictive policy when it isn't needed.
Okay. Anything else you'd like to put it in terms of sort of, potential unknowns, the risk, or however you want to put it in terms of 2024?
Well, it looks like 2024 is going to be the economic soft landing that the Fed really hoped to engineer with their hikes and getting inflation under control. We can certainly hope so, but then there's always the exogenous event that puts shock into the system and changes the outlook. So we're going to keep our eyes open.
Excellent decision. Okay, great. Thanks for that, Terry. Max, let's have a look at Canada. I guess last year was all about inflation. If I remember rightly, it peaked just over 8% or so and has come down fairly significantly since then. Are we at the stage now, perhaps, whereby the Bank of Canada could be amongst the first of the major central banks to cut interest rates?
I'm not sure about that because, compared to the U.S., maybe the employment report wasn't so solid, but wage pressure is still high, and that's the stickiest point the Bank of Canada is afraid of. In the CPI, coming down to around 3% is fine year on year, but the path from there to all the way to 2% seems to be still bumpy, and I don't think the governor of the Bank of Canada wants to leave any impressions that they're ready to cut rates. And that, as you can see in the stock markets or bond markets in North America, suggestions or the prospects and expectations actually do a bit of a job of soothing the markets and economic outlook. So the housing market is already showing signs of recovery because of the shortage of affordable housing overall anyway here in Canada. So I don't think they want to remove the reference to they'll tighten if needed.
All right. Let me play devil's advocate here because that's always good fun. December the 15th, we had the Bank of Governor, the Bank of Canada Governor Macklem saying that, to quote, excess demand that drove prices higher over the past 2 years is now gone. As higher interest rates and tighter global financial conditions have helped the economy to rebalance. We've also had, GDP real GDP pretty well flatlining now for quite a while. I mean, GDP per quarter has been falling for the last, 4 or 5 quarters, whatever it is. And of course, next year, we're going to have the housing market hit by a significantly higher interest rates for no Canadian households which have got to remortgage. Do you think the BOC's got any real concern about what's going on, perhaps more on the real side of the economy than inflation, or is it still all about inflation?
I think they're looking at both sides of the story, and the governor has been really careful about how to describe the current situation. He's been saying it's a very difficult, decision they have to make. They care about people losing jobs or households still seeing elevated costs for daily necessities.
Right.
But then he has to make this textbook kind of a comment that in order to help the households and businesses, they have to bring the inflation down, because if they let it stay high, then it's going to take more interest rate hikes. So I think they're really torn. The board is governing council is really trying to they're hoping to see easing signs in wage pressures and companies' pricing behavior.
Right. Yeah, interesting. You say close call, isn't it? Trying to pick the balance right. And it's okay. Well, anything else from your side on Canada in terms of big issues for 2024?
Well, as you can see, not many prime ministers are popular in this world. So I
choose one.
I don't
yes.
know, but Trudeau, I spoke to former government officials, and then they say Trudeau doesn't seem to care what he looks like in the eyes of the public. So he'll probably stay on, and there's no strong contender to lead the Liberal Party. So we'll see what happens to the actual approval ratings.
Right. Okay. So we'll keep an eye on that one. Right. Let's move down to Asia then and Japan. Well, I don't know what we've been talking about, this long-awaited BOJ tightening throughout 2023, and you quite correctly have said, wait for it, and it's still somewhere right around the corner. Are we now really any closer to it? And is it still wages that matter most to the BOJ?
The answer is yes to the latter point that you just mentioned. It's not a dual mandate like in the U.S., but they've been tying the achievement of stable, sustainable 2% price target to a substantial increase in wages and hopefully real wages. So in the absence of actual data or agreement between major companies and then trade unions, they cannot move right now. I think the market expected some had to hedge and saying they may move in January, but because of the earthquake too, I don't think that's going to happen.
Yeah, I was going to ask you on that. There's a comment I saw which came out of the bank governor. I think it's back end of December, remember rightly. Well, I wrote down in my notes. To quote, "It's possible to make some decisions even if the bank doesn't have the full results of spring wage negotiations for small and middle-sized businesses." I mean, is that the sort of comment you might expect him to make, or is that, do you think, something which might suggest they're starting to lean in the direction whereby they've almost decided they want to start tightening policy, and they're trying to drip feed the market as they have done in previous actions, to get them ready for when the action actually takes place?
I think the key is Professor Ueda is a honest man. He's not a former government bureaucrat or career central bank governor. He was on the board before, but he's trying to how would I express try to describe the situation in the clearest way instead of using the communications to guide or lie about their intentions, what they're going to do. Like, the biggest criticism of his predecessor, Crota, was weeks before the bank introduced the negative interest rate. He kept saying, no, that's not good for Japan. But then when he came back from Europe saying, well, I was actually impressed by what they're doing in Europe, and we're going to introduce this new policy tool. And then really left the impression that he's a liar. So then compared to whether he seems to be, he's more academic, and he's an academic type, and I think he's trying to give the most up to date observation, but at the same time, I think his staff want him to weave in some comments to, like you said, make the markets ready for what's going to happen, because it needs real shift in mindset. And I think Japanese people are getting ready for actually in the more normal world of, there's an interest rate. If you buy something or borrow, then you have to pay a higher interest rate.
How do you set it without unsettling the markets too much, isn't it? Okay, anything else about Japan that we should be aware of this year?
I'm just looking at the Bank of Japan's calendar, and the key dates are April 25th, 26th, July 30th, 31st, October 30th, 31st. That's when they release the quarterly outlook report. So these are more appropriate times to say, okay, this is our latest outlook for GDP, CPI, and then risk assessment. So these are the times when they can actually convince people that they have to, for example, end the negative interest rate policy and back to zero, and then eventually finish the yield curve control. And whether they have to keep political developments in mind or not, they would say they're not influenced by political schedules. But as you can see, Kishida government's approval rating has been declining lower and lower, and because of the political funding scandal and public dissatisfaction with, like abrupt, that was a year ago, plan to increase defense spending with all tax hikes. So the BOJ wants to avoid when, for example, the raising rates when the prime minister has to resign, or they have to, the prime minister has to call a general election. But we're past midpoint 2 years, so last October, and that means they still have time to call the election or wait until the 4-year term of the lower house, which is going to be October 2025. So they still have room to maneuver, and but then obviously, the Bank of Japan on the weather wants to start normalizing the policy framework gradually. So something has to happen this year, I think.
Okay, another one. Watch this space, as they say. Many thanks for that, Max. Right, let's go to Mr. Jackson and China. I don't know where you want to start, really, Bron, but I guess we can say, well, in the end, 2023 wasn't as bad as it could have been. But I think, as you've talked about on previous podcasts, the data perhaps have been flattered, at least on a year-on-year basis, by some of the weakness we saw in 2022 caused by COVID. But I mean, where does China go from here? I suppose the big question is, are policymakers taking what appear to be deep-rooted systemic problems seriously enough?
I think under the surface they are, but the actual public pronouncements that come from Beijing don't really give a good indication, I think, of exactly what they might be considering behind closed doors. You only have to go back a few weeks when we had the official data for November published. We have sort of a big day of data every month. And they didn't really let on to serious concerns about the state of things. They said the national economy had good momentum and was turning for the better, and so no sort of indication that they're too concerned about how things are going or that they are planning a big shift in policy. We are, though, sort of in the middle of the period where they do re-evaluate policy. They normally have a big meeting in December and then get ready to announce growth and inflation targets and other sort of big policy changes at the big National Congress meeting in March. So I think right now it's a little bit too early to tell whether there will be a major shift in what policymakers want to do. It'll be more the big Congress announcements that come up in March.
Okay, fair enough. Can I ask about, in terms, it's always difficult about politics and trying to relate that to financial markets, I know, so perhaps it's an unfair question, but looking at some of these, the capital flows going through markets, the third quarter, if I got it right for China, saw the first deficit on foreign direct investment, I think, ever, or certainly very close for a very long time anyway, as it seems to be overseas companies now are becoming that much more reluctant to invest in China. Do you think that's a concern for the Chinese authorities, or do you think they regard it as A, doesn't matter anyway because they're busy acquiring overseas assets, or B, we're going to do our own thing and we'll just continue down our own route?
Again, there'll be the difference between the public and what goes on behind the scenes. But it's definitely striking. As you said, it's an unusual event, and before we had the fall, we had much lower growth as well. So there definitely is a sense that foreign companies are voting with their wallet and not liking some of the trends and outlook for the Chinese economy, and that's an indication that officials will definitely pay attention to. Obviously, the Chinese economy has had all sorts of challenges in recent years with COVID, then the zero COVID policy, the down in the property market. So you could argue that, okay, maybe this is just reflecting some sort of short-term one-off events and that things will pick up. But what you are seeing, from some of the more longer-term analyses that we see around this time of year is just concerned that perhaps the Chinese economy does have these sort of deep-seated structural problems that is going to persist for much longer than just any sort of short-term issues. There's obviously large amounts of debt for many of the regional governments. There's really no sign that the property market is going to turn around anytime soon. And sort of more fundamentally, people are pointing to just the demographic issues, whether that's going to restrict growth going forward. And a lot of think pieces saying, or perhaps China is going to have a lost decade like Japan did back in the day. And what does this say about the longer term outlook for growth? So lots of I think on the sidelines, a bit of pessimism about the longer term outlook for China has picked up as well. So that again is going to be a challenge for policymakers to try and address. When March comes around and we have the outlook for the whole year.
All right. Yeah, it's going to be an interesting one, isn't it? Right, before we ask you about Australia, just quickly to touch again on Saturday, it's politics, but clearly we've got these elections in Taiwan next week, isn't it? If I remember rightly.
Yes.
How important do you think that's going to be, given all this talk about the problems and the ongoing political battle wills, if you like, between what's happening in China and what's happening in Taiwan at the moment?
I mean, obviously, there's always concerns every time Taiwan has an election. There's a lot of articles and a lot of ink is spilled, talking about the potential repercussions.
Yeah.
And touch wood, we haven't had any major developments that result from these elections for a long time now. We have had Chinese government again reiterating its policy, and again that's nothing new. That that they're very adamant in stating that policy in the lead up to Taiwanese elections. But that sort of understanding between Taiwan and China remains in place, and I think that will that's the way to bet going forward, that we won't see anything serious happen. But it's still always a bit of a nervous time while we just wait to see what the outcome of the election is, and if there is a change in government, what the stance of the Taiwanese government will be after an election.
Yeah, right. Watch this space again. Okay, hit me with it. Australia, what are the big issues as far as 2024 is concerned?
Will inflation fall quick enough? Will we be able to avoid a serious slowdown in the economy, given the impact that higher interest rates and the cost of living pressures are having on the economy? So yeah, that's to be determined. It's a matter of waiting to see what the data says. Definitely, lots of angst at the start of the year about cost of living pressures and the impact that is having on households. And so, we're going to have a lot of pressure, I think, on the RBA to do something about that. And it's just a matter of how they respond to it, particularly under the new leadership of the new Michelle Bullock.
Sorry, I was going to ask you. Sorry, quick interrupt. I was going to ask you on
Yeah.
that. So obviously you've got the new governor in there now. Does that have any implications for policy?
I don't think so, because she's the sort of the internal candidate when they did replace him. So she's been around for a long time, sort of making the decisions that have been put in place, and so she does represent to a large extent stability in policy. So I don't think that will make a huge impact. It will still just continue to be based on the data and their assessment of the outlook. That said, there are changes though coming to the RBA this year, which will be interesting to see how that plays out. Last year these changes were announced, and now they're going to be happening, mainly just sort of in the process of monetary policy. So as people may know, usually before now we've had basically monthly meetings except for January, so 11 meetings per year. That's been cut back now to 8 meetings a year starting this year. So basically every sort of 6 weeks or so. So the idea behind that is to give officials a bit more time to go in depth between meetings, analysing whether there does need to be a change in policy settings. The meetings are also going to take a little bit longer. They'll start on Monday, finish on Tuesday. And the other big change is that there will be a bit more transparency around those meetings. There's going to be a press conference from the governor, an hour or so after each meeting. So that'll be interesting, just to give people an opportunity to grill the governor about what officials are thinking straight after the meeting. So that I think that will be quite interesting and quite well followed by the markets.
Okay, excellent. Anything else on Australia?
Anything else? No. Just the point about when we were talking before about the Fed and when they might start cutting rates, that obviously is also starting to get a little more attention when we might actually see a cut by the RBA. The consensus view amongst economists at the moment is that we will see a cut around the end of the year, so September or a little bit later. And looking, there's
so still some way away then.
Oh yes, yeah. People are still expecting it's going to be towards the end of 2024,
right.
And a lot of people do not see a rate cut at all. So just looking at the range of forecasts out there, there's quite a few people who don't have anything penciled in for this year, but the median forecast is for just one towards the end of the year, and then another 3 over the course of 2025. So nothing too drastic in terms of unwinding that policy tightening that has taken place over the last 18 months.
Which could make for a potentially presumably good year as far as the Aussie dollar is concerned.
Yes, possibly.
Right, you mentioned some changes to the RBA. I noticed, we've had going across the water to New Zealand. The National Party led a coalition after October's election, wasn't it? They amended the RBNZ remit in December to just stick with an inflation target and remove the objective to support maximum sustainable employment. Has this got any big implications, the fact that they've shifted from the kind of Fed-style dual mandate just to having a simple inflation target?
I mean, on the margin it could, but my impression of the RBNZ is that that they always take all the major economic variables into consideration when they're choosing when there's making policy, and so there could be circumstances, I guess, where there is quite a discrepancy between what the inflation target would have them do and what the employment target would have them do. So to the extent that you are no longer paying attention to the employment target, that could have a bit of an impact. But in practice, I don't think it will make a huge difference. They're still very much dealing with the fact that inflation is well above where they would like it to be, whereas the employment numbers are probably a bit closer to where they'd want them to be anyway. So I don't think that's going to make a huge difference. It's still going to be what do we need to do to get inflation lower, and so I think that will still be the main focus going forward.
Okay, great. Right, I know, so you cover quite a lot in the area, but last one, excuse me, last piece I wanted to ask you was regarding India. I know in the last podcast you were pretty well kind of talking up India in terms of prospects for 2024. Again, I mean, I hate talking about politics, but we got these elections in April and May coming up, haven't we? Do you think they're going to be important the way investors perceive India as an investment country for 2024, 2025?
I suspect no matter what the result, that positive sort of outlook for investors will remain. To be honest, I don't know too much about the opposition party's platform on economic policy. I don't think it'll be that much different from the incumbent party in terms of continuing on with opening up parts of the Indian economy to foreign investors. Retaining a good relationship with the Reserve Bank of India. I wouldn't expect a big change in sort of fiscal responsibility going forward as well. So I think the outlook is pretty much going to be the same no matter what the results of the election are on a sort of long-term framework. But obviously there could be a bit of short-term volatility if we get an unexpected result. At the moment, my understanding is that most of the opinion polls are showing that Prime Minister Modi will be returned to office after those elections, but obviously we'll get more information as we get closer to April, May. But I think the RBI has a pretty good record of being able to continue on with its job despite any sort of volatility that's going on in the political sphere. Okay, excellent. Anything else from your side? No, that's it. Sounds good. Okay, brilliant. Okay, many thanks for that, Brian. Let's wrap this up then with some Euro. What do we got? Well, as far as Eurozone's concerned, then
For the ECB, it's still really all about inflation, but I would guess in terms of looking at the numbers with added emphasis on the core rates rather than the headline numbers. It was, well, not surprising by any means, but interesting that we had the flash December data out the other day, and that showed a jump in the headline rate up to 3.9% from 2.4%, which might get people thinking, oh, perhaps they won't be cutting rates after all. But the core rate was down to 3.4 from 3.6%. And it's very much just a simple reflection of the fact that energy markets had such a huge impact on inflation, headline inflation rate in Europe, and indeed as it did the rest of the world during last year. And it's going to have a similar impact on 2024 as well. So it's going to be the underlying rates that the central bank, European Central Bank, will be focusing upon much more closely. In terms of the real economy, well, the Eurozone economy itself, strictly speaking, isn't in recession at the moment, in a sense that we haven't had 2 quarters of negative growth. But we know that the third quarter contracted, and to all intents and purposes, from what we've seen on the data so far for the fourth quarter of last year, it looks as if that will carry a negative handle as well. And one of the big issues, and I guess really it is a big watch as far as 2024 is concerned, will be Germany. Germany's had a really rough 2023. The manufacturing sector has been hit extremely badly, both by the weakness of global demand, but also with the weakness of domestic demand as well. The German consumer sector has been hit particularly badly by high rates of inflation, at least by German standards anyway, and concerns about the budget deficit in Germany. Worth noting that we had plans from the administration to try and reallocate some of the, what I think is about 60 billion euros worth of COVID-19 loans, to reallocate them towards climate protection. And that was overruled by the Supreme Court, which essentially means in terms of fiscal policy in Germany, there's a whacking great hole at the moment in the government's budget plans. That needs to be filled under their own stability program rules, which means that Germany, if anything, is going to suffer another period of potential austerity, or at least some form of austerity anyway, at a time when the real economy is already struggling. So although clearly Germany being the biggest Eurozone economy needs watching just as a matter of course, it's going to have a particularly big impact, I think, in terms of the overall shape of the Eurozone growth in terms of 2024. More generally, though, in terms of the policymakers at the ECB, a bit like Max was talking about with Japan and wages, and indeed Bank of Canada and wages also a major focus as far as the ECB is concerned. There's around 40 to perhaps 50% of all European employees will be settling new wage agreements at the start of this year. Now, the data probably won't be fully available to the policymakers until perhaps May or June time, something like that. So the hawks on the ECB will certainly be wanting to defer any interest rate cut until they know what's happening to these settlements. And I guess it's still probably the case at the moment that perhaps financial markets are getting a little bit overly excited about the pace at which interest rate cuts might be delivered from the European Central Bank in 2024. I think, having worked so hard to get inflation back down to current levels, the ECB, like many other central banks, will be loath to give anything away, and they're be prepared to perhaps in some ways to keep interest rates a little bit higher for too long, rather than cut interest rates too quickly and see inflation start moving back up again. And it's worthwhile noting, I suppose, that in terms of the current disinflation path that the ECB assumes, and that's based on its own sort of financial conditions, assumptions, and so on, involves significantly less policy easing than what the markets are currently anticipating. So in other words, if the markets prove right in terms of interest rate reductions on the ECB's own models, it would suggest that inflation would end up far too high again and back above target. So in other words, there's upside risk in terms of market, what the market is currently discounting in terms of interest rates for inflation. So again, it sort of suggests, at least in terms of ECB thinking, which of course may be wrong anyway, but in terms of ECB thinking, it's kind of they do believe that financial markets too aggressive in their expectations for interest rates. Elsewhere in Europe, well, obviously we talk about the war in Ukraine, which is ongoing desperately, and it's anyone's guess, I suppose, as to when that's finally going to finish. But obviously that's an upside risk in terms of prices and indeed on budget deficits across Europe as well. Also, in the context of fiscal policy, 2024 sees the return of the Growth and Stability Pact, which was suspended due to COVID, of course. This lays down the rules that on debt and budget deficit that the Eurozone members are supposed to achieve over the medium term. There actually means some revisions in terms of that, but it still essentially means that for this year, the aggregate fiscal stance across the Eurozone should be contractionary. And that really is just going to reflect, well, what almost amounts to a complete phase out of the remaining energy related measures which were involved during COVID. And I guess that, at least if nothing else, we got fiscal policy now helping the ECB in terms of helping to pave the way for it to lower interest rates. The other big watch in terms of the continental Europe this year, I suppose, will be the EU parliamentary elections. They're due between the 6th and the 9th of June. As things currently stand, it looks as if the Eurosceptic populists will be securing their best ever results. But in terms of what the current opinion polls are saying, it still looks as if the existing coalition of what centre-right, Liberal, Social Democrat and Green groups, they're still expected to retain an overall majority. Still, there could be, with growing populist and economic pressures in most of the 27 members of the European Union, is going to complicate decision making, almost certainly what comes out of these parliamentary elections. And that could be a bit of a worry as far as international investors are concerned. What is certain, though, is that there won't be any expansion of the euro currency in 2024. If people remember, Croatia joined at the beginning of 2023 to make it a 20-member bloc currency. But of the 27 EU members still to join the currency, some, like Bulgaria, have yet to meet the convergence criteria, and others like Denmark, Hungary, Sweden as well, they all remain reluctant to do so. So at least in terms of the euro itself, it's going to remain still the 20-member currency as it is at the moment. Elsewhere in Europe, in terms of the UK, if we believe the latest numbers, recession might have been avoided in 2023, although it's still very much a possibility after revised down the third quarter growth numbers. And either way, it's certainly something that the UK government won't want to see ahead of what is very likely to be a general election in the UK in 2024. So when we get the March budget, expect that to be loose, and almost certainly we see some tax cuts coming through there, which could certainly bolster the UK economy and also leave the Bank of England that much more cautious about the speed in which it cuts interest rates. Indeed, on that front, I mean, 2023 was a pretty dreadful year for monetary policy. The core CPI, core inflation in the UK, hit a record 7.1% last May, and it's 5.1% at the moment, at least that's as of November, the latest data. So that's still, 2.5 times or so the medium-term target. So I think in terms of the MPC, the Monetary Policy Committee, they really are quite desperate to restore some sort of credibility to policy, and that will probably mean delaying rate cuts until after the lights, I guess, of the Fed and the ECB move. And again, that might be another factor supportive of sterling. So although the actual economic numbers in terms of the real economy for the UK might not look too clever, in terms of potential interest rate differentials, given what's likely to happen to fiscal policy ahead of the election and what the Bank of England will probably be doing, interest rate differentials may well work in favour of the pound. In terms of the Bank of England, what they're looking at, I think we've touched on previous podcasts, is a bit of a quagmire for them in the sense that the labour market data, as the Office for National Statistics admits, now just downgraded to experimental because they've had so many problems with their surveys. So I think it's worth noting, some of the reports which the Bank of England itself puts out. So we have the quarterly bank agent surveys which come out. As mentioned, they're quarterly, announced at the same time as the MPC meeting announcement on those dates. So keep an eye on them. And also the bank's so-called decision makers panel data, which doesn't always get a lot of attention, but the bank asks these chief financial officers, if I can say it, chief financial officers from around 2,500 or so firms about what's expected in terms of prices and wages as well as current conditions. And that's the kind of input which the MPC takes extremely seriously. So if they do have problems with the labour market stats, it could well be some of these sort of, the bank's own survey data that help to determine as and when and if they're actually going to come out and change interest rates. So I would certainly recommend having a look at them. In terms of election, that has to be held by the 28th of January 2025. The latest coming out of Downing Street is that Prime Minister Rishi Sunak prefers second half of 2024. That's all he's prepared to say at the moment. But with some people noting that the upcoming budget is being set for the 6th of March, which is a little bit earlier than usual. There is some speculation that it might come a bit sooner. Personally speaking, I think looking at opinion polls, the Conservatives are so far behind that it's more than likely they're going to leave it as late as possible in the hope that something will come out which actually gives them a boost in the polls. In terms of the election itself, I say in previous years, the investor view has always been that a Labour government would be unfriendly to businesses, and so probably negative for the likes of sterling and the equity market. From what we've had coming out more and more from the Labour Party over the course of the last 6 months or so, they do seem to be adopting a much more friendly business stance, which is a positive. They've also reiterated, crucially, that the Bank of England's independence would be retained, and indeed the Office for Budget Responsibility, the OBR, which provides the economic and financial forecasts which go into the budget projections, that would also be protected as well. So I suspect as an outset, the idea of a Labour government, which perhaps in previous times might have been caused a few wobbles in terms of UK financial markets, should not necessarily perhaps be the case this time round. Let me quickly round off from my side in terms of Switzerland. Of course, the Swiss franc has been a star of the currency world for some time now, buoyed since 2022 by capital inflows caused by the war in Ukraine, and more recently by, of course, the Middle East developments. However, it's worth noting that the Swiss National Bank in December pointed out that although it's still willing to intervene in the FX markets to try and keep the currency market stable, it wouldn't be conducting foreign exchange sales anymore to reduce its balance sheet, which has been part and parcel of its policy for a while now. Now, that may mean that it's kind of a backhanded signal that current levels of a Swiss franc are about as high as they want to see. So should we see falling interest rates generally trigger a shift into sort of a risk on investing, we might see the Swiss franc actually start to struggle a little bit. And indeed, should the war in Ukraine end sooner than anticipated, that could also put some downside pressure on the franc. So for time being, at least, clearly Swiss franc is still very strong, but at least potentially there's some developments in the calendar during 2024 which could lead to some downside potential. Round off then, what else we should be watching? Well, between the four of us, we've talked a little about elections, and there are a lot of them around the world in 2024. In fact, if you look at the overall schedule, if the numbers are right, there's close to voters in around about half the world's population will be voting during the course of 24 in the main election. So it makes it potentially the most important year ever for politics, and that of course means it's going to be a major test for democracy, and of course a potential trigger, if you believe the polls, for a shift to more populist or nationalistic policies, and that of course could mean a return or a boost to current trade tensions, in turn dampening perhaps growth or boosting inflation prospects. So what comes out of these elections could be important for investor sentiment during this year. Commodity markets, of course, we haven't really talked too much about oil, and to be perfectly honest, I think it's anyone's guess as to where oil's going to go. I mean, last year we saw a first down year for US oil prices since 2020, and that was really due to worries about oversupply, despite the fact we saw some fairly significant cutbacks coming through from OPEC. What will be worth watching there, I think, is that although we've got this ongoing political risk in various parts of the world, not least amongst the oil producers, the likes of US, Brazil, Guyana, they're all producing crude oil at a record pace at the moment. So it does seem that there's going to be a growing emphasis on the importance to the supply of production from the likes of the US and other Atlantic Basin countries, and certainly keep an eye on them, because it may mean that the impact of OPEC on oil prices over 2024 and going further beyond that is going to be less than we've been used to in the past. And of course, Brian was talking about China. Well, what happens to Chinese demand, given the amount of oil they suck in, is going to be hugely important. Climate change, you could spend a whole podcast on that, but it is worth noting that the drought we've already seen has forced some restrictions in the Panama Canal. That's led to reductions in capacity limits and longer waiting times. Traffic, of course, going through the Suez Canal, that's been facing escalating terrorist attack from the Iran-backed Houthi rebels, all of which means longer delays and higher costs for deliveries. In fact, weather patterns everywhere clearly have become increasingly volatile. So, really no matter where you live, it seems that there's implications for flooding and or drought, and that's going to have some sort of impact on economic activity and prices in general. All, in other words, adds to what is inevitably the usual highly uncertain outlook facing investors and policymakers alike, as we have at the start of each year. And I guess that is just about the most appropriate note on which to end today's podcast. But whatever happens, remember, you can always keep up to date with all the key market data and sort of the key moving market data and events in Econoday's global economic calendar. And with that artist diatribe, the Econoday team would like to wish all a happy, safe, and of course profitable 2024. On behalf of Terry, Max, Brian, and me, thank you as always for listening, and we look forward to talking to you all again very soon. Bye for now. Strategic investing and analysis are a lot easier when you can identify patterns and see how economic events and announcements correlate with specific market movements. The Econoday Investors Journal provides a convenient and easy way to follow important economic events every day, every month throughout the year. View the most important market-moving events for the upcoming year in a glance. The Econoday Investors Journal is your essential desktop resource for economic events and indicators, FOMC meetings and announcements, US banking holidays, equity settlement dates, and more. The Econoday Investors Journal is much more than a financial calendar. It's an indispensable tool to help you anticipate active days in the market. Learn the intricacies and interactions of the market, record daily market activity, and explore helpful insights from experienced market analysts. Take advantage of our informative resource centre, which includes a comprehensive glossary of need-to-know terms, clear, concise information on policy and historical trends, useful graphs, and a guide to the influencing factors and people to watch at the Federal Reserve. Order your Econoday Investors Journal now at shop.econoday.com.